Hi, Nick Heath, Client Relationship Manager here at U Asset Management, and I'm delighted to welcome you to our quarter in review. And joining me on the sofa is our Chief Investment Officer, Mr. Shane Balkham. Hello, Shane.
Hi, Nick.
Great. Now, Shane, we're halfway through the year. It feels like a lot has been going on. There's been a lot to contend with. Can you just share with our clients what's been going on at kind of economic market level?
Yes, the first half of the year has gone extremely quickly. Both quarters seem to have had echoes of each other. Mm-hmm. Unfortunately, the dominant factors still maintain to be inflation rates, as well as where interest rates are going to be, because central banks only have blunt tools to try and combat inflation, and that is by raising interest rates. That's been the main factor going throughout 2022. It was the main factor going in 2023 as well.
Okay, and can you just remind the viewers out there what actually is the target for the Bank of England in terms of inflation? What are they actually trying to pull those measures to?
Well, it's been a long time since the Bank of England got anywhere near their target. Prior to COVID, the target was 2% and remained to be 2%, but it was well below 2%. During COVID and in 2021, when inflation started to rise, we saw a brief period where the Bank of England actually hit target, and then it actually shot way past it as well.
So talk us a little bit about consumer spending. So I'm kind of thinking, inflation is, extremely high. Viewers of this particular conversation, I'm sure will recognise that, a pint in the pub or, that loaf of bread now feels extremely expensive. So, are there any signs that actually consumer spending is beginning to kind of fall?
No.
Okay.
No, there isn't any signs as yet. I think the unusual situation with the UK is because interest rate rises were put forward in such a truncated time period. You're only getting to a situation now where a lot of people's fixed rate mortgages are coming off.
Yeah.
That jump in price is going to hurt a lot of people if they haven't experienced that before. Sadly, my fixed rate mortgage ended in summer last year. I'm loath to fix at the rates we're seeing at this moment in time. So the Balkham household budget is certainly feeling the pinch. I think there's a lot more households yet to feel that. That's, I think, will have a dramatic effect on consumer spending. Also, we're still in the situation of people using that pent-up demand that they couldn't spend over when COVID we had lockdowns. So I think once that's out of people's systems, we might see a reduction in consumer spending, which brings another problem for the Bank of England in terms of slowing growth and the spectre of a recession on the horizon.
Now, of course, the other side of the equation with interest rates is that, if you are a saver, you're now got the possibility of actually earning something meaningful on your cash. I'm sure there are some people out there actually thinking, well, why don't I not just invest my ISA money into cash rather than the stock market? How do we kind of respond to that particular challenge?
No, that's a very, very pertinent point in the market cycle. It's, for the first time for a long time, cash is delivering a reasonable level of return. However, if cash is going to deliver 5% for the sake of argument, the normal economic conditions then would assume that cash as your lowest risk asset class, bonds, in order to invest in bonds, you need a reward. You need to be compensated for going up that slight risk scale. Bonds should provide more, and equity should provide even more. I think the danger we have at this moment in time is cash looks attractive because there's a sea of uncertainty investing in the markets. And I think at 5%, that certainty outweighs a unknown number with investing in the markets. What we have seen in the past, that investing in cash can be a bit of a lobster trap, behaviourally, rather than as in you can't get your money out. Of course you can. But once you've invested in cash, if you see the markets go up, suddenly there's a lack of willingness to enter the market at a higher level than you could have done.
So let's begin to kind of lean into how we're positioned tactically within client investment portfolios. So could you just give us the headlines, and then perhaps we can then dive into some of those more interesting asset classes?
No, that's really good, Nick. I would say we are very consistent in our tactical views at this moment in time. Tactical views being those short-term opportunities that move away from our long-term structures. For us, we are still overweight UK and still overweight Japan.
Yep.
In order to match that off, we're underweight European equities. And that's been in place for the better part of 2 years. What we have seen, particularly this quarter, is that overweight in Japan really pay dividends for us. It's something that's really hit the headlines, how attractive Japan can be. We've had some of commentators come out saying it's the best environment for Japan in their history of working. So for us, it sort of gives us credence that we identified this as a good value opportunity, but back over 2 years ago, and we continue to see that it produces good diversification in the portfolios, and as well as good returns to our clients.
Shane, could you perhaps walk through some of the interesting manager changes that we've made over the last quarter or so?
Thank you, Nick. Yes, we've made changes to both diversifiers and equity side. If we take diversifiers first, one of the big changes we made under the model portfolios as well as the multi-asset blend funds was we've sold our last holding in a strategic bond fund. That's a manager who has free rein on to decide where to invest. What we want for our fixed income is a explicit areas of investment that we decide on. So you don't have any unintended risks of investments that are doubling up on your view. So we've sold Janice Henderson strategic bond, and we've bought a passive vehicle, iShares, long duration US Treasuries. Now, we've chosen that purely because they should perform extremely well in an environment of steady or lowering of interest rates. And we feel we're getting towards the peak of interest rates, so it's a good entry point.
Now, recession is what, 2 quarters of negative growth?
The technical definition.
Is the technical definition. So when I think of recession, that sounds like an extremely loaded, terrifying term. What is that actually going to look like for people in reality? How will that manifest itself, I guess?
I think there's 2 ways it's going to manifest itself. I think you'll see a situation where companies with robust balance sheets, with quality management teams, should be rewarded for that. And there's management teams that have experienced different market cycles. So I think the stock market will favour those companies. Companies with weaker balance sheets, less cash generative, will be those companies that see their share prices potentially fall. So you're going to get a definite splitting of companies into those that are good and can survive, those that are weak and may be in a lot of trouble. And I think that's going to be geographical, not just in emerging markets or developed markets.
Yeah, and I guess that taps into the point again about having a globally diversified portfolio, right? Because, of course, we feel the pain of what's going on in the UK. But I guess if you think it through an investment lens, there will be hopefully plenty of other countries where we mentioned Japan, where their economy is actually booming, their companies are booming, and you're getting your returns into the portfolio and all of those things that we've kind of discussed earlier. Okay, so Jay, you've shared with us, our tactical view. We talked about which managers we're using to execute those decisions and our view going forward. But of course, that's all very interesting, but how has that affected the performance of portfolios?
It's been positive. Year to date, because we're halfway through the year to date, all of our range of portfolios have given a positive return on the back of course, don't forget the last quarter of 2022. So over 9 months, over 3 quarters, some positive returns, which is great. In general, majority of portfolios delivered a positive return in Q2 as well. So it's looking a much brighter picture than we had in 2022. Markets, of course, try to look forward. I think markets are looking forward to a period where inflation has got under control, or interest rates are coming down to a normal. And a normal is not back to zero.
Mm-hmm.
Zero interest rates were the sort of aberration that we had since the global financial crisis. Going back to a normal area of between 2–2.5%.
Listen, Shane, really appreciate you sharing your thoughts with our audience, and thank you so much for watching and listening. Thank you for investing in our portfolios. A couple of things to draw your attention to. Firstly, the client quarterly report will be live and available on our website. You should also receive that in your inbox. We've got a wide range of client guides, education guides, if you like, on our website too. So please do check those out. And also, we've got our YouTube channel. So hopefully you're watching this video on our YouTube channel, and we've got another wide range of videos there that are worth checking out. But that's all from us for now. Thank you, Shane, for your time.
Thank you, Nick.
And
Thanks,
thank
everyone.
you for watching. Cheers.